Good morning, traders. It is Friday, October 17, 2014. It's 8:06 a.m. Chicago time. Thanks for joining me. I apologize for the delay. Experiencing some technical problems. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations are subject to change without notice. Past performance is not indicative of future results. A quick rundown of the overnight news, things that may be affecting today's trade. European equities and German bonds yields rise, but remain on track for weekly losses. Sentiment remains fragile. Italian bank shares gain sharply as short selling bans are put in place to stem the rout. Looking at just rehashing a little bit what was important yesterday. Feds Bullard came out. Feds Bullard is not a voting member, but he came out and said that the Fed should consider delaying the end of QE. I believe there's one more session of QE of reduction for it to be ended. And then Google announced after the close yesterday, it came in at $6.35 versus $6.53. Slightly worse. The stock fell about 5% on that news. U.S. housing starts came out at 1.17 million versus 1.008 million. So slightly better. Building permits came in slightly worse at 1.18 million versus 1.03 million expected. China's central bank's planning to inject 32 billion US dollars equivalent in yuan into 20 large banks. Hong Kong protesters clashing with police. Remember, this protest has been peaceful all along. Looking ahead at expectations for today as far as economic releases, we've already had the building permits and so forth as stated. What's ahead is the at 8:55 Central, approximately 25 minutes into the open, we have the University of Michigan confidence number. This is the prelim number. It's a medium to high importance number, expecting 84.2. 84.2. That's the key release that's coming up. Fed's Yellen's currently speaking. She started at 7:30 at a Boston Fed conference on inequality. She did not release any statements relating to the economy, not expected to. So other than that, other than the fact that the Fed chair is speaking, and at 8:55 we have the University of Michigan, we really don't have anything else for today going ahead. Let's take a look at our charts. Several things I want to cover with you here. Now, my intention was yesterday to have you look at some spreads just to see the broader picture on what the market is doing. Unfortunately, I wasn't able to do that yesterday, and I attempted to put those together for you today, but I was not able to. But I'll show you a couple things that are of interest. First of all, let's jump right into the fundamentals. Let's look at my fundies chart. This is the S&P 500 here. I know it's hard to see because I have it squished so much. This is a daily bar chart of the SPX index, the cash index. I've regressed the channel back. The channel used to be up here going across, and now I've pulled it back to the low of 2011. And I've projected it forward. This is the bigger channel. As you can see up here, we broke below it a couple of days ago, and the market's doing its best to get back in. So a break like this is not an indication that something is off, because if that was the case, I could draw a trend line from here to here, project it forward, and see that this was a clean break right here. So if I took this and connected it here, I would see that I have the same thing way back here. which would indicate that the market's actually failing through the trend line early on in 2012. And we know what happened since. So trend lines are important in that they kind of nicely wrap the price action around something that we can visually see and understand. However, be careful not to draw large bias conclusions based on a trend line, because trend lines can be walked on. It's a subjective process. Do I connect it here or do I connect it here, where we actually have a lot more room, to the downside? Why am I choosing to connect it there? Was this just a test and it fell back in and it continued higher? Or so just be careful. I know there's a lot of discussion. I know the bears are out in full force right now, and that is fine. Everybody, one of the beautiful things about the market is that everybody gets their day, as long as they're managing risk well enough to stick around. And that's really what I focus most of my effort on. To make sure, to try to do the best we can to make sure that folks are around when the market starts starts rewarding their particular edge. But one of the things that I wanted to point out is a chart that I posted yesterday. If you look at, this is the second standard deviation this is the first standard deviation for the New York Stock Exchange up versus down stocks. Stocks that are making new highs. Okay, so what's important about this, I want to expand that out. What's important about this is this tells us what is normal. When are the new 52-week highs on the New York Stock Exchange starting to go out of what we would consider to be normal, going back as far as this chart does. This chart goes back 1,000 days. So I did a quick study to figure out what the first standard deviation is for 52-week highs and a first standard deviation for 52-week lows. The same number, 396, it's actually around 380 something, is the second. It would be the second standard deviation of the New York Stock Exchange new 52-week lows. So it's approximately the same line as this green line. And what has happened in the past is, as we cross that line, as we did back here, we mark a bottom. So if we look at this chart of the SPX, we pretty much have a bottom here, a failed bottom. This is what a week low looks like. But still, the 52-week lows spiked way, way high, had about 1,379 at the peak. And that marked, basically, that was a day, the day of the bottom, and then the market bounced back up, and it could not find buyers, so it made a lower low. But there were fewer 52-week, new 52-week lows on that second try. Yet again, it is above the second standard deviation. Okay, and then we take that forward. So let's zoom in here a little bit. We take that forward to June of 2013, and we find again that the 52-week low, the new 52-week lows, get above the second standard deviation again, and that pretty much marked that bottom. Over here, it came in early. We had another excess 52-week low here above the second standard deviation, and that did not quite mark a low. However, all in all, every time this has crossed above, and especially when it pushes through the 500 mark or so, it has marked a temporary bottom at least. So far, because of the strong uptrend, it has marked a swing low, and we had that day before yesterday. We reached 611 stocks making fresh new 52-week lows, and that's part of the decision. That was part of the hypothesis yesterday that I typed out on Twitter, that I'm expecting the low to be defended. The prior day's low, which is Wednesday's low to be defended at 1813 in the ES, and the expectation was for the market to start working itself to 1887. You can see that tweet from 2 days ago after the market at about 5:30 Central on Wednesday evening. So this is what I was looking for yesterday. I was looking for the market to stabilize and hold this low at 1813. Now we came in yesterday with a very strong sell here on overnight news. The European markets just tumbled, and they caused us to push all the way back down to 1813. We got to 1815 and a quarter, and we balanced in this area, creating a pretty weak environment for that hypothesis. Still, though, I did say that I'm expecting this 1813 to be defended, and really that's what we got yesterday's action. So let's take a quick look at what happened yesterday and go over what, and so that can lead us into what we expect for today. So yesterday we opened out of value but in range. We had an open auction. You can see here that the market traded both sides. It moved up to 26 and a quarter, pushed to 22.75. Found buyers, pretty decent buyers, as we can see from the delta here. Again, the volume delta is simply measuring how much traded at the offer, or how many people aggressively crossed the market to buy versus how many people aggressively crossed the market to sell. And it's the sum of those positives for the offer and negatives for the sell. And that gives us the net delta, the net result of those transactions. So this is not an indicator. It's simply giving us a visual record of how much volume traded at the offer minus how much volume traded at the bid. Strong aggressive buyers. I did expect some resistance at 30 early on. Pushed to 30.75, little pullback, about 3-point rotation back. The first target was 30.75. The second target that I posted was 18.40. So we had a small 3-point rotation. We did find resistance here. If I cut back to a 2-tick Renko, you'll see that it kind of created a small zipper here and broke through. Then it went directly to the next target, 18.40, and pushed through by a quarter for another 4.5-point rotation. Then we balanced here. This 18.40 is a composite low volume node. We expect a reaction and a struggle here. Pulls back to VWAP, and then off it goes into the prior day's close. This was all well and good. The market started to balance. It was looking kind of weak, actually. It was not able to exceed the low. The next area up we're looking for was 18.49 for the prior day's point of control. And it's just when the market broke through the VWAP here and through the mid, it was starting to look iffy. Fed's Bullard came out in here, and you could see that the strong delta and a massive rotation of about 25 points here straight up. This took approximately 3 minutes to cover about 25 points. Very, very strong, and that pretty much set the tone for the rest of the session. That a Fed speaker is willing to come out and say that the Fed will react to the action that we've had, this excess volatility that we've had over the week. Pull back to the mid again, balancing, digesting the news. Did not quite pull back to the scene of the crime. Market seems primed to squeeze some shorts out. And for the shorts to start taking some profits. And so it starts to balance with an upward skew, and then it manages to push through, not quite getting to our target, the next target up at 74.75, but doing a good job of pushing through. Remember, 1887 is the composite LVN that we're shooting for. Let's take a quick look at where that comes from and why. because that's what it's all about. I'm not giving you trade ideas. I'd like you to get your own by understanding the auction. Whether you're trading stocks or even options, determining strike prices and so forth, understanding the auction and where the market like to trade is such an important part of that. So this applies to whatever it is that you're trading. When I'm looking at equities and sizing up equities, I pull in volume as well and just cut the increment back to 10 cents, 10 cents per price level. So we could not quite push down to 1784, which is the next cutoff, the next key CLVN. 1850 is the most valuable price or the most traded price in the area. Remember, 1850 was the key target from yesterday, and we exceeded it. And this is why I said I'm expecting a battle here. If you note, it is not random that we close right at 1850. Right at 1850. The point of control, 1851, it was actually at 1849 for quite some time before it pushed up to 1851. Why is that? The reason is the market has memory. The market understands value. This is also a major strike, and there's a lot of volume that's expected to go through in and around this area. But the market pushes to 69.75 and comes right back to close at 1850. That is not a coincidence. Back to the auction, the general auction behavior. As the market battles here, the 1850 area, I do expect another leg down. I'm looking for another leg down. I'm not sure when, probably at some point next week, unless, of course, some central bank or central banker comes in and intervenes. But essentially what we have here is a driving or an impulsive move that is likely to flag a little bit and then complete itself. And the target for completion is 1784, which is the next cutoff. As the market goes back to the high volume node, the expectation, since this is a low volume node or an extreme, this is a low volume node or an extreme, the expectation is that if the market cannot test the lower low volume node or the lower cutoff point, it is likely to hold the high volume node and then work itself back into the next area above if it's not able to push lower. So 1887.75, and that's why I put that number out there. Yesterday overlapped the prior day, so we created balance yesterday. Because we created balance, I create what's called a micro composite to see what the where the volume was on both days. If both days are trading, if this day is trading the prior day's range, then I want to see what the value of those two ranges together is. The MC point of control, as you see here, is 49 and a quarter. Right up against the 1850, no surprise there. And then as the market's trading up here at 73 and a quarter, it forces me to pull these 2 days into the composite, because these 2 days are in balance. I can't just pull 1 day in, I have to pull in 2 days, and then it gives me a map of where the volume is and where the action is likely to take us. So the level to take special note of today is down here, the 1865, which was I stated as resistance either yesterday or the day before. I guess it was yesterday. 1865 is really important. We have a zone here, an LVN zone. As long as buyers hold this area, then we are already at the next high volume node, which is 1875 right here. And then the profile is blunt. Today, it's important to pull in, to have a look and pull in and see how these days traded the next day up. So we're up here at 1875. We're at the point of control that we left behind in gap below from Tuesday. And then we need to look at Tuesday's chart profile. And when we look at Tuesday's profile, we see a nice little cutoff here at 1878.75. That is the key LVN right here. There's some print on top of it, but This is the key LVN. Look at where the overnight high is, 1878.75, right on top of it. So I'm looking for, on today's action, the primary hypothesis is for responsive selling back into the prior days, to test back into the prior days range. Value high is right up against the 1863 area. And remember, 1865 is key below. So the expectation is it either pushes up and pushes the 78.75, which I'm expecting to see resistance in that area. I'm expecting sellers to respond above the overnight high today. The key expectation is for the market to possibly test this on the open. We're opening in about 3 minutes, and then to push lower to test 69.75, but I expect it to try to push down into the 65 where it's likely to find buyers back through. In either case, I expect the overnight high to be broken. The key target above, again, 1887.75 is the key target above. We had somewhat of a balanced trade on Tuesday, and 84 is the value high. So this area here provides some confluence for some initial, and I repeat, initial potential resistance once we get up there. So if you're long into that area, my method of managing the trade is to scale something off, if not close, ahead of the 85 and 87.75. If you're not, then you might want to look for market weakness as we approach there for an initial short scalp with a runner possibly into the prior day's range. Today, again, we have that Michigan sentiment number, so it's expected to drive us a little bit. But overall, the market has put in a higher value area, higher low, higher high, with a point of control that's on top of each other. The market is likely to be imbalanced, and that's why the expectation is more to push lower than it is to run higher on this gap up. We're going to be gapping out of range here, so the opening is supposed to be an open auction out of range before the sellers step in and push this back through. That's my primary trade idea. If the market proves that wrong, if we open and just run off, then I know that my targets are 87.75, 94, 1900, and then I'm going to start looking at this template day, which is Monday, and the market's likely to walk itself back to 1909 as a key target above, but not likely today. Hopefully that's helpful to you. Again, it's Friday. It's been a very volatile week. I've watched those people this week. This week has been a lot of indication from the effort that I've been making over the last 3 years to move into being able to see how the online folks are trading through the brokerage that I'm involved with, Stage 5 Trading. I do ask that you check us out and support us. But I've seen a lot of people who got crushed, and those are the people who I expected to get crushed when volatility picks up. It's those people who don't use stops, don't set daily loss limits and so forth, and it's just sad to see. That's not what I want. That's not the vindication that I want. The vindication is that we have a lot of accounts, and I watch risk all days. I watch the markets, and it's incredible how well people have fared during this added volatility. And I'm very proud of the fact that a lot of people had daily loss limits, and a lot of people sat on the sidelines and really managed their risk first. Those who manage their risk first, there's no guarantee of success in this business, but those who manage their risk first stand a better chance. Good luck. The markets are open.